Well, mutual funds is the focus of this panel discussion. So let me set the context of what we are discussing because investing is no longer an exclusive bastion dominated by a coterie of wealthy, seasoned investors or the older generation or old school financial advisors. Internet penetration in the remotest corners of the country and the advancement of technology, they have democratized investing. So now people belonging to different age groups and from varying runs of the socio-economic ladder, they are finding the confidence to embark on their investing journey as technology makes investing easier, less expensive, and more importantly, more accessible. Amongst financial instruments that have catalyzed financial inclusion in the country and pulled many investors to the investment arena are mutual fund investments. With more investor participation, the mutual fund space is also seeing disruptions. Better industry participation, evolving regulations, expansion of quality product offerings, new investment philosophies, and the growth of sophisticated digital distribution channels. The mutual fund investment ecosystem is evolving rapidly. So, our next segment is going to touch upon the investment trends to watch out for in the mutual fund space. And to outline all of these points, we have another panel of fantastic speakers. So let me quickly introduce our panel to you, starting with Kaustubh Belapurkar, who's the Director for Fund Research at Morningstar Investment Advisor India. Also with us is Joydeep Sen, corporate trainer, author, and columnist. And with us is also Amit Bibalkar, Managing Director and CEO at Sapient Wealth Advisors and Brokers Private Limited. And finally, we have with us Abhishek Singhal, Business Head, Passives and Alternate Strategy at Aditya Birla Sun Life Mutual Fund. Gentlemen, thank you so much for joining us and looking forward to hearing your thoughts on this topic because mutual funds has seen such a massive evolution, the ecosystem itself. So, Kaustubh, let me start with you. Considering there are fears of, let's say, the trickle down effects in India of the global recession, the question on many minds in the viewing audience is that is it a good time for novice investors to enter the markets now? And if yes, according to you, what are the things that they should keep in mind? So let's address the elephant in the room first.
Sure. Hi, Gautam, and hello to all my fellow panelists. So I think the simple one-word answer to that is yes. And let me, every time is a good time to invest in the markets. And let me kind of elaborate that through some data points to support that sort of argument, right? Now, this is not the first time that we've seen volatility in the markets. There have been many times over the past couple of decades where we've seen external sort of crisis or events causing upheaval, be it the global financial crisis, we had the Fed taper tantrum, more recently we had the COVID crash. All of these, we've seen market corrections, but what the most important learning is that if you stay put in the markets, you've actually really made good returns from the markets, right? And that's a very simple study when you look at say the broader market, the Nifty, and do a rolling return analysis. And that's where I think the first thing that investors need to keep in mind is have a sufficient time horizon when you're entering the markets at any point of time. Because the longer your investment time horizon, the more sort of reasonable your returns and more predictable your returns can be from a volatile asset class like an equity. And let me support that with some data, right? So when you look at the over the last 22 years, the Nifty rolling returns, if you came at any point of the market and invested for only a 1 year period, your return on some time could have probably been 100+%. Times when you actually made negative return, and that proportion was almost 30% of the time. That means 3 out of 10 days, you invested, you would have lost money, right? So then it becomes a very important issue of timing the market, which obviously we don't ask investors to do. But as you extend this time period of the going rolling returns in 3 years, 5 years, two things you notice: that your average returns become more predictable, and more importantly, the probability of a negative return, which most all investors would hate, goes down significantly. In fact, beyond a period of 7 to 10 years, the probability is almost close to zero, which is great, right? That's why we always say that equity is a great long-term investing class. You should have a sufficient enough investing horizon when you come into the market. That's, I think, very important. I think the previous panel touched upon asset allocation, so I'm not really going to delve into too much detail, but I think that's obviously the golden rule that you should have an asset allocation in place, which really helps you decide, the way your portfolio should be constructed. Few other,
Mm.
I would say behavioral hacks that you need to keep in mind. Invest regularly. That's, we talk about the power of SIP, not trying to time the market. SIPs are a beautiful way of doing that. Continue to do that. Uh, you have to be patient, right? So if you're coming in a market, there have been time periods where the market's been flat or negative over extended periods of time, maybe even a couple of years. But obviously, if come in with an investment horizon which is much longer than that, you need to be patient. And that's where I think employing and finding a good financial advisor can work wonders, because most often we as humans have behavioral biases. We can make rash decisions, and that's where a financial advisor who can be a financial and a behavioral coach can work wonders for your portfolio, making sure that you don't take these wrong decisions. So I think that's broadly what I would kind of outline, that yes, anytime is a good time. Take a staggered approach, be patient, and have the right time horizon. Use a financial advisor to make your decisions.
All right. Because of 2 points here from an average investor perspective, right? First is that investors, if they hear, say it's a novice investor, and they hear from the expert saying that past performance is not an indicator of future returns. So then the next question for them is, okay, so how exactly should I judge a mutual fund? And the second is on the aspect of patience, because a year or two or maybe even three, right? And then the investor starts wondering as to when their patience is going to be rewarded, when they especially look at asset classes which are rising. So what would you say on these 2 points?
Yeah, absolutely. And I think again, very valid observations, Gautam, because, and we keep talking about this cliche that time in the market is more important than timing the market. To the second part of your question, right? Let me again support that with some interesting data. Uh, if you're not investing in the markets, right, and you're waiting to time the markets can run up in a hurry, as we've seen. And we did a study, just looked at the monthly return time series of the markets over the last 10 years. And what it showed us is that just 8 out of those 120 months over the last 10 years accounted for the entire outperformance of equities as an asset class over cash. That means if you were not invested in equities in those particular 8 months, that is only 6.7% of the time, of the entire time period, you would have made returns less than a liquid fund. So the whole point is that you have to be as a part of the journey, to make money from the journey, because markets are a very strange beast. And we saw in the COVID crash, a lot of investors were waiting on the sidelines, and the markets ran up in a hurry. So don't make that mistake. Continue to invest. I think that's the most important thing. And mutual funds are a beautiful way of doing that. I mean, you have great actively managed funds. You have a lot of passive options. You can pick either of these, but the point is that you have to be invested in the markets at every point of time, to actually benefit from this long-term investing. Like I said, there will be periods where you feel frustrated, the markets are not going anywhere, but that's, history has taught us and will repeat, that there will be periods such as this, but there will be boom periods where you need to be there to make the money out of it.
All right, as the saying goes, karmanye vadikaraste ma phaleshu kadachana. Focus on the karma rather than the results that you get. Focus on the work. So let me come to you, Johnny, for the question on how investors can benefit from periods of market volatility, because at the end of the day, it's not a straight cut approach. You can also benefit from periods of market volatility. So outline some of the steps investors can take.
Hi, Gautam. Hello to all the panelists and all the viewers. Yes, it is very important because there is a mindset, there is an apprehension that volatility is an enemy. But volatility can be your friend also if it is properly used. Now, let me distinguish between investors and traders. And here we are discussing investors only, as in long term investors and not the day traders. So, for the long term investors who are accumulating wealth over a period of time, I'll talk of a few very simple yet very powerful tools which the investor can use for making volatility your friend. Firstly, the allocation ratio. Let us say there's a portfolio of say 70-30, 70% equity, 30% debt as an example. In times of severe market correction, like it happened in 2020, Jan to March 2020, market index fell by like 38%. Now, when you do a portfolio review, just to maintain that ratio of 70s to 30 in times of severe market correction, that 70 would have become like 60 or 50 or whatever that number is. Now, on a review, when you rebalance your ratio and you bring that 50 or 60 up to 70, that means automatically you are buying equity cheap. Other way around, in times of severe, significant market rally, when the 70 becomes 80 or 90, you book some profits in equity and bring it back to 70-30. This is different from timing the market. Timing is different. We just do a plain, simple portfolio review, simple yet powerful tool. Next point, SIP. Everybody knows what is SIP. Now, within SIP, you can increase the amount in times of market correction or adverse market valuation. So most mutual funds have this tool or method that in an SIP, so there are in-house tools. They follow various tools like price to equity, price to book, market cap to GDP, momentum. There are multiple tools, in-house tools. As per those tools, and if you are subscribing to that method or that tool of SIP, in times of attractive market valuation, the mutual fund itself will increase the amount of SIP. And in times of rich valuations, they will decrease the amount of SIP. That means effectively you are using volatility, you are buying more equity in times of correction and other way around. And my third and last point, if you are a direct investor, you are buying equities or bonds directly. It is possible, of course, you can do. But the point is, when you are a DIY investor, you are doing it yourself. Somewhere down the line, discipline takes a backseat. You get busy with your other work and things like that. If you are doing it through the mutual fund route, there is an automatic discipline because the mutual fund is doing the work for you, doing that rebalancing and increasing and decreasing those things, and you benefit from it automatically.
All right. As we've heard, the word volatility, if you embrace it and you are confident in the face of volatility, you can make sure that your investments work for you. That's the message coming out. Meanwhile, Amit, let me come to you. Things have changed since the last Mahakumbh, as we see in the markets. And from that perspective, I want to get your take on passive investing, because at one point there was a huge amount of optimism in doing passive investing, but once people see markets kind of volatile, holding around the same levels, they end up wondering what exactly to do. So your take on passive investing and what kind of goals and risk tolerance abilities that it caters to.
Morning, everyone, and thank you for having us on the panel. Uh, Gautam, I would like to say that उम्र बिना रुके सफर कर रही है और हम ख्वाहिशें लेकर वही खड़े हैं. So most of the times when investors actually look at doing investments in either an active or a passive fund, they try to compare it with someone or they try to compare it with something. So when you are looking to invest your money either through passive or active, what is your khwahish? What is your desire? What is your goal? You need to write it down first. And who are you comparing it with? Are you comparing it with your neighbor, your colleague, your benchmark, or are you comparing it with yourself? I think we have to learn to beat inflation not only as individuals but governments too, and we have to identify as to what is my goal and how am I going to reach there. Passives in the developed markets, Gautam, has been a very big hit. Why? Because the alpha in that market is very difficult to achieve. Almost 90% of the fund managers in the developed markets are not able to beat the benchmark, and that's why you have seen more money moving towards passive. If you talk about India, then you have seen over long periods of time, you have seen fund managers actually outperforming the benchmark. And therefore, if you are trying to look at a relative comparison to the benchmark, then active investing will always beat passive, in my opinion, in the next 5-10 years. But in the last 2 months, in the last 6 months, you have seen passive investing coming in debt as well. So forget equity, we have seen even debt mutual funds coming with passive index funds. I think there the idea is very clear. In my opinion, you invest in debt not for returns but for protection of capital and a post tax better return than a fixed deposit. So if you are going to invest in debt, it is safety, then liquidity, and then returns. When you are looking to invest in equity, obviously you are taking a highest risk, therefore you are going to look for higher return. And if that return can come by saving in the expense ratio, by going into index funds, by going into passive investing, then so be it. But buying a passive fund at 64,000 and buying a passive fund at 42,000 of the Sensex, or 8,000 of Nifty and 18,000 of Nifty, that also is challenging. So you need to first ascertain as to with whom am I comparing myself. If you go to a South Indian restaurant, Gautam, you'll always find the dosa on the other plate more crispier than yours. So it is very difficult to actually see that whom am I comparing with. And so write down your goals, write down your desires, and then see what kind of product can fit. Active passive is more to do with 1 or 2% difference over long periods of time. If you feel passive is simple and it can serve your purpose, definitely you should go for index or ETFs as well.
All right. I think when talking about the dynamics of passive investing, I can bring in Ghalib's quote as well, which reads, "हजारों ख्वाहिशें ऐसी कि हर ख्वाहिश पे दम निकले, बहुत निकले मेरे अरमा, लेकिन फिर भी कम निकले." All right. We've understood what's the dynamic for passives. Let me bring in Abhishek to throw more light on hybrid funds and multi-asset funds. So Abhishek, over to you. Give us the complete picture.
Yeah. So good afternoon, everyone, and thank you for inviting us here. Um, this is a category, and I think first of all we should be celebrating India's coming of age in terms of mutual fund assets. We crossed 40 lakh crore of AUM, which is about half a trillion of assets, and though still not comparable to Western world, developed world, we are still way below in terms of percentage of GDP. But another trend which is emerging is that equity and hybrid put together is roughly half or slightly more than half the assets in the country. Out of the big pie, we used to have only equity funds earlier, or very structured solutions like balanced funds or MIPs in terms of hybrids. Today, you have various gradients of hybrid solutions. I think the mantra over the last 2 years, as volatility has increased, has been asset allocation. Every panel is talking about it. Our friend Joydeep also talked about moving from 30/70 to 90/10, booking profits, bringing it down. But how does an investor do it after all? There are several issues that investors face. One is tax cost on every churn that they do. Second is, how do they time it? Are they really equipped to do it? Though one of the media reports in July 2021 said that there were over 100 millionaires in Nagpur, most of them chartwalas and panwalas, and all of them DIY investors. Now, the fact of the matter is, there are behavioral biases. How do I know when to get out, when to get in? How do I book profits? And the last one is, am I a DIY investor or am I an advised investor? End of the story, there are balanced funds, there are hybrid funds, there are asset allocation funds. These are all hybrids. Anything that is investing in more than two asset classes is a hybrid fund. And the fund house is doing it for you at a reasonable cost. If you want to, save on expenses, come in the direct plan. If you want to, get advice on short-term timing, as Kostubed brilliantly put it on the data, short-term investors will face more volatility of returns. Longer-term investors will have lower probability of negative returns. Um, you know, Hybrid funds are doing it for you. And as far as multi-asset funds are concerned, let me be very candid. Whenever the entire industry puts its might together, the category becomes big. Balance Advantage Fund, which is the key hybrid category today, is a pseudo equity category, and it's the third largest category today. It's close to 2 lakh crores in size. That's because everybody has launched a Balance Advantage Fund. And as the industry is running out of options in terms of NFOs, the next wave that you're going to see is multi-asset. To be honest, it does make sense also. If you look at gold as an emerging asset class, and over the last 15 years, incidentally, gold has outperformed equities by over, I think, around 2 percentage points. Given the fact that investors don't know how to time it, it's best addressed through a multi-asset fund. These assets will allow you to switch across three asset classes or more: domestic equities, domestic fixed income, gold, and perhaps even international equities. And that, I think, is coming of age for the Indian markets. We are getting more and more aligned to the Western world, where the focus is is more on risk adjusted returns rather than on absolute returns or outperforming markets. So, so my guess is that this is a category which will grow faster. This is a category which will have more permanent assets rather than short-term assets, and you will have more retail participation building up much faster in the coming years.
All right, Abhishek, just like we are in a hybrid work world, are we entering an era of hybrid investments, in your opinion, hybrid investment vehicles?
Oh, absolutely. Today you look at and Amit just briefly talked about passives. A key category in passives is fund of funds. You see, if you look at the actively managed fund of fund category, the asset allocation category is the one which is growing extremely fast, uh, because of the fact that it serves two or three issues. One, it cuts down the cost of tax for the investor. Every time I want to take an asset allocation call on my portfolio, I'm incurring a tax cost, a short-term capital gain or a long-term capital gain cost. While through an FOF route, that cost is taken care of, and even in a multi-asset or a hybrid vehicle. Second, I think one of the key issues with our markets is lack of awareness or lack of understanding. Uh, so, what do I do with my general savings? I want to save for, let's say, 3 years or 5 years, and I don't have a goal. I think hybrids is getting you that. And for novice investors, especially, it's a good participation in equity markets, rising equity markets at a much lower level of risk. Balance advantage as a category, arbitrage as a category, hybrid equity hybrid as a category, and now multi assets. And the last one is that it's serving a very important purpose of retirement saving. There's a huge retirement saving gap for the country. I think a few days ago, even Nitin Kamath had commented on it. I think hybrids serve that purpose. If you look at EPFO investments, they have gone hybrid. They have already started investing about 15% in equities. So I think we are entering an era of hybrids. You will see a much higher growth rate on solutions than on absolute asset classes like equities and fixed income.
All right. I also want to bring in some other themes. Amit, you have a point to add here.
I think everyone has ideas, Gautam, but very few have patience. So if you really try to look at many products and everybody will have ideas, I think patience is not limited to waiting after buying. Gautam, waiting to buy at the right time too is patience. Most of the time,
Hmm.
this fear of missing out. Like today, if I hear correctly, then people are talking of gold has outperformed equity over 15 years, and suddenly you
Hmm.
look in the back mirror and start investing in gold. Now, why gold goes up? Because equities go down, gold goes up because you are seeing inflationary trends. But going
Hmm.
forward, whether this will continue, so patience is nothing but making time work for you. And I think intelligence would definitely be of help, but it is patience which will actually create fortunes. So whenever you are investing in whichever product, I think patience is very important. And if people say compounding is the eighth wonder, I would add patience is the ninth wonder. So we should have patience along with compounding and whatever product you choose, but you should have patience along with compounding working for you.
All right, that's the headline coming there. Patience is the ninth wonder. And speaking of some of those points that you mentioned, Amit, I myself was surprised when I checked gold prices. Right, it was a while since I went to a jeweler and inquired about gold prices. But when I realized what price it was, you're right. Suddenly, that pressure comes on you to explore it as a sort of an investment opportunity rather than having a sort of a measured view and understanding the dynamics at play. That gold is a hedge against inflation or volatility, and therefore you can invest appropriately, as we had discussed in the last panel, whether it's sovereign gold bonds or gold ETFs or so on and so forth.
So last year when
Uh,
you had quizzed us, Gautam, if you remember last year when we had this Mahakumbh, the largest money went into a technology fund based on past returns, if you are aware and if you remember that. And you have seen what has happened in the next year. So I just hope that people don't make such kind of mistakes because it's actually real loss of capital which happened.
hmm,
And retail people have to be aware that you need somebody to handhold. I'll not take much time. Just one example that when you do a direct purchase on a shopping website, then if the sneakers don't fit, you have an option to claim a refund or exchange. But when you
hmm,
do it directly for investments, there is no refund or exchange. It results in actual loss on your capital. So
hmm.
that's why you need
That's a very
somebody
good
at least
point.
to go and out. Yeah.
Absolutely. As you mentioned, patience, and you also need a bit of understanding to see how things are panning out, because there are no refunds or returns when it comes to your investment. Let me bring some other themes into play here as well, especially on sustainability, because let's not forget a lot of the new emerging class of investors, especially millennial investors, they're thinking a lot about this ESG. That's the buzzword catching on. So let me bring in Kaustubh for this, because Kaustubh, ESG investing has become a buzzword to reckon with in the global investment arena. So what should investors here keep in mind when taking that ESG route of investing? Because I read recently, I think some green bonds are also coming into play from the government. So lots of opportunities are opening up in that space as well.
Sure. So Gautam, I think, just to set the context, often, I mean, you're right. I think ESG, sustainable investing, has become massive globally. Europe is leading the way. Other countries like the US, Australia, Japan are fast catching up. In India, this conversation has definitely started. I think there's still a long way to go. But I think the one thing that, often there are a lot of misconceptions, or, kind of frameworks that people don't necessarily always appreciate or understand about sustainable investing. And the most common, understanding is that, okay, I'm going to be buying clean energy and things like that, something which is pro climate. Now, see, there are various frameworks for sustainable investing, and they've existed for a fairly long period of time. The most basic one is what we call just values-based or exclusionary investing, which is, you say that, okay, I don't want to buy certain sin stocks, I don't want to buy tobacco, I don't want to buy gambling stocks. That was the initial framework. A large part of where ESG investing is now evolving towards is actually integration, which is happening in India, which means that you're thinking about the environmental, social, and governance risks that a company is exposed to, which can, financially impact the company. So it could be in terms of either loss of business, loss of fines, or just loss of brand value. And there are several examples that there are both from a local or global context. I mean, we know what happened with British Petroleum when they had the oil spill more than a decade ago. More recently, we've seen what happened with Volkswagen with the emission scandal. Similarly, in India, we had on the social side, we had the Maruti labor crisis, which took a significant impact on their business and their stock price. Similarly, with Nestle in India. So I think the examples are many, and that's where managers and investors look to understand what are the inherent risks that come in with from an environmental, social, and governance aspect of the company, and what is the company's management doing, or what policies do they have in place to kind of address them, right? So that's one very popular form of sustainable investing that's very popular. And we have a lot of increasing number of funds in India too. The third one, where the global markets are now kind of gravitating towards, is more impact-based investing. They're saying that, okay, I also want to make a difference with the money that I'm getting into, say, clean water, clean energy, maybe gender diversity, and there's several other themes that can be there. And active ownership through, we've seen this even happening locally, where managers are voting, with the money on the stocks that they own to get the right practices from the company management. It could be regarding managerial pay or other such instances where they're guiding and nudging, company management to make the right decision from an ESG framework, right? So that's just kind of the broader context about how sustainable investing has various frameworks, and I think investors need to appreciate and understand where do they really want to look at, kind of making their investments, right? From a local context, a couple of great moves have happened. Obviously, one is the regulator's been very proactive, so they've obviously asked for corporates to make enhanced ESG disclosures for the top 1,000 listed corporates. So that's only going to improve, the visibility on what companies are doing. There are local funds, ESG funds, that are available now that an investor can look at, and while there's still a handful, but the space is going to grow as time comes. And third, more importantly, fund managers themselves, local managers, they've been doing this for actually, I would say, for a reasonable amount of time. The local Indian asset managers, they're already integrating this ESG, risk frameworks into the investment policy. So, earlier it was purely on a financial standpoint that, okay, I'm going to assess a company for its growth potential, profitability, margins. But they're also now increasingly assessing that, okay, what are these ESG risks that a company is exposed to, and what is the management doing to address them? Because if down the line, if they don't address them, it could have a significant financial impact, as I quoted some of the examples earlier. So I think that's the move that's happening locally.
Is
And
that a
this
broader systemic thing we are looking at, Kaustubh? As in a lot of the fund managers also looking at ESG risk into the broader portfolio that they have, rather than just having ESG based funds into the broader investment universe? Is ESG risk becoming a systemic frame? Is it becoming a systemic point that fund managers are looking at?
Absolutely. I think this, I think, and even like I said, from a local context, for many years, obviously, governance has been a very key focal point for local managers. But for many, many years, even the E and the S side of things are increasingly being assessed and spoken about by several local asset managers. They may or may not have a ESG fund, so to speak, but they're, while it may not be fully integrated in the investment process, it's obviously it's a graded measure that you would take, and over the years you will see that being fully integrated. But they're definitely cognizant of this, because globally, asset owners and managers are already doing that for a long period of time, and I think Indian managers have also been successfully kind of integrating that quite well over the last many years. So I think this is only going to continue, and we'll come to a point of time where everything is kind of looked at with a sustainable lens. So you may not even have everything will be an ESG fund, or it'll be just like you look at funds fundamentally, you would do the same thing. But that's obviously some ways down the line. But definitely a popular trend. And just to quote some numbers, right? When I think about from a global context, there are close to about 5,000 asset owners and managers globally that are UNPRI signatories, and between them they have about USD 100 trillion in assets. Obviously, not all of them come with an ESG lens, but even when I look at public mutual funds, they've seen increasing flows, especially since COVID. Almost 1 trillion came into ESG or sustainable funds, since the COVID crisis globally. Europe leading the way, and currently the assets are in excess of about $2.5 trillion. So so it's a growing and a much needed addressable market, and I think India we're getting there. There could be a long runway, but definitely steps in the right direction.
All right, let's consider the fact that if there are investors who want to be ahead of the curve, and of course they want global exposure. Joydeep, let me bring you in to take this conversation forward from a broader lens rather than just ESG. For investors who are looking to diversify and have more global exposure, and they're considering investing in international mutual funds, what's your thought? Because there are concerns of a global recession. So how do investors navigate this landscape according to you?
So, drawing from the earlier couplet, "Khwahishe dunya bhar ki hai, vasudhaiva kutumbakam." So, talking of your earlier concern, which you expressed, Gautam, on the recession, my individual personal view, the recession, if it happens, it will be a mild or technical one. And how or why I'm saying this thing. As of today, global central banks are hiking rates, and they will hike for some more time. But maybe 6 months, 9 months down the line, they will pause. They will have to pause because they don't have the wherewithal to bandwidth to hike as much. And maybe somewhere down the line, maybe 1 year down the line, at least in the USA, they will actually cut rates. That is one about interest rates hampering global growth or leading to recession. Second point is about this Russia-Ukraine war and sanctions, which is the root cause for this high inflation as of today. Hopefully, somewhere down the line, people will find a face-saving solution. And as and when the sanctions start getting lifted, the impediments to global trade, which is happening and leading to high inflation, that should hopefully improve. And hopefully, the world should become a global better place. That's about the recession part of it. Now, coming to this point. Now, as I earlier said, allocation is always relevant. One is the broad allocation like equity, debt, gold, and other asset classes. And even within equity, we have domestic and we have international. Today, obviously, India is the growth story, the fastest growing major economy in the world. So allocate to India. 80% of your portfolio, 85% of your portfolio allocate to India. But there is a case for international global diversification also. So what is the logic? If you look at data over the last 10, 15, 20 years, and if you look at year-wise returns across countries, across markets, US, India, China, Europe, across markets, even in today's world of interconnectedness, no, on the lighter side, US president sneezes and the world catches a cold. But to look at it seriously, even anything happening in the world, we get to know in 1 second. The world reacts. If you look at data, every year the winner varies. Some year it is Nifty, some year it is S&P Dow Jones, some year it is Euro stocks, some year it is some other market. So what I mean to say, it is not that there is a one winner every year, where the role of diversification comes in. So on the global growth, concerns are there, but maybe over a period things will improve. What could be the other rationale, other logic to invest globally? If you have some plans abroad, maybe son, daughter, education, settlement, you may have any plans abroad. So how do you send money abroad? One is the LRS route, other is the mutual fund. Of course, subject to mutual fund limits and all those things. As long as limits are there, you can use the mutual fund route or you can use the LRS route. But diversification is always relevant. Today it may seem like IT is beaten down, global recession and things like that. But history shows that, like, as Amit said, technology fund was a boom at some point of time. Today, what looks beaten down may be a better bet 5 years or 10 years down the line. So allocation always leads to better risk-adjusted returns. So that is the logic for investment abroad. India, yes, India is the growth story. So invest a major part of your equity portfolio in India. But yes, there is no harm in doing a bit of a allocation, because there are many growth stories abroad also. Like here we have the proven stocks like large caps, mid caps, small caps. Globally also, on one hand we have FANG and we have other stocks also which have growth potential. So as long as you're investing a good feeder fund or some other fund with a global listing across market, not just USA, Europe, China, whatever. Even China, today it seems like whatever issues they have, but you never know, 1 year, 3 year down the line, they may come back. So at that point of time, today's partial diversification portfolio will give you the end results. So that is the logic for global diversification.
All right, Joydeep, just to add a point here, because there are limits to, say, investing in some of the US funds, which have been imposed by the regulator here. In that context, for someone who's, say, looking very US focused investing and finding they come up to these limits and want to, say, conserve their firepower, investment firepower, how are things looking for debt or fixed income investments in India, according to you?
Okay, so firstly, on the limit thing, so ETFs are available. One can buy ETFs, one can use LRS. On the second part of your question, on the Indian diversification, debt investments today are much better than earlier. Earlier means, let us say, 1 year or 2 years ago. And what is the reason for that? 1 year ago, 2 years ago, if you look at the portfolio accrual levels, which is the portfolio YTM, was much on the lower side. If you look at it today, the portfolio yield levels, what we call carry yields, are much better than earlier. So if you invest today, you're in a much better platform than earlier. Next point, talking of the rate hike cycle, about the RBI. We are at the end of the rate hike cycle. On coming 8th Feb, we may have one more rate hike, 25 basis point, and if it happens, that should be the last in this rate hike cycle. So what it means is we are looking at stability in the debt market yields now. We saw volatility last 2 years, but we are looking at stability now. So what it means is if you invest in debt today, going forward over the next 1 to 3 years, we're looking at stable markets. Next point, possibility over maybe say 3 quarters, 4 quarters down the line, RBI may actually look at rate cuts depending on how inflation pans out. Inflation should cool down, and there may be a requirement of a rate support in India also in terms of global recession and all those things. So RBI may actually look at rate cuts, and if that happens, it will support growth fund returns. So there is a case for that also, and it's a good time for investment in debt funds now.
Absolutely. Interesting. We truly live in interesting times considering how the rate cycles are panning out across the world. But moving the conversation forward, Amit, your thoughts on retail investors warming up to exchange traded funds? Your thoughts on that?
So just to take what Joydeep was mentioning, Gautam, if I look at what you are wearing today, everything is made outside India. So when you are investing in any portfolios, you are buying commodities which are not made in India.
I would differ from that. This is an India-made tie. This is a Satya Paul tie, and I think this was a suiting bought from Raymond. So I'm all made in India, just to clarify.
Okay, all right, fine. And the same will go with your car, I think, with your spectacle and with your Apple Watch in years to come. So
that I would agree.
The point being that when you talk of growth in India, you talk of sales numbers. When you talk of sales in India, it only means consumption. And when it means consumption, you look at anything what people today are buying, they are actually importing. and that is creating this inflation problem. So on debt side also, it's a very simple rule. When your home loan becomes unaffordable, your debt investments become attractive. So what you have to look for is availability of money and the rate at which you are getting that money. So if both of these, you can see that the availability is shrinking and the rates are moving up, fantastic time to invest in debt funds. I would also like to say that for people abroad or their sons abroad, Gautam, you're getting dollar assets at 4 quarter or 5% for a 1 year period. This is not a recommendation, but there are many money market funds also there which are available at 4 to 5% dollar yields, which I think is very, very attractive. Coming to your question on retail and how people are looking at the ETF category, I think more and more people who cannot afford to invest lumpy monies through the brokers are definitely going in for ETFs as a model. And I would like to remind you that ETF is not only of equity, but you had benchmark mutual fund, which also started with liquid bees way back, so which can also be used as margin for your broking account. So ETFs have been in use for quite some time, and I think retail is very much warming up into ETF as a category. You can also have various sectoral ETFs which you can buy where there are no funds available. So there are some people who are also buying into some sectoral ETFs where you have no funds which are available today, like a auto ETF. You can buy, but you cannot buy it into index fund. So there are many categories where retail people are actually going and buying, and I think ETF investing globally has become big. And in my view, ETF investing in India also will become big. But again, I said that कामयाबी हमेशा समय मांगती है and समय हमेशा धैर्य मांगता है. So if you want to be successful, you have to have time and you have to have dhairya with you, and then you will be successful wherever you invest.
Absolutely. Make sure time is on your side. Well, we're almost coming to the end of our panel. So let's see if time is on our side for the remaining duration that we have. Abhishek, I'll come to you with the last question of this segment and ask you what are some of the common misconceptions about mutual fund investments which are being perpetuated by social media that investors, in your opinion, should let go of in 2023? I believe you're on mute, Abhishek. If you can unmute yourself.
So sorry, my bad. I'm saying January is a good time. New Year is a good time to have resolutions, and usually the first one is that I will get up on time. I will go to the gym. I will stop doing this, stop doing that. One of the misconceptions, or rather, one of the resolutions one needs to have is read lesser and lesser into social media. While social media is fantastic for awareness, for keeping up to date, we've also seen some of the flip sides of it. One of the biggest ones that I've seen, at least in the recent past, is the age of new investors. While it's fantastic that the industry has added phenomenal number of investors per month, there are more than 2 lakh demat folios getting opened for some of the large brokers per month over the last maybe about 2 years. The number of investors that we've added in the last or post COVID is more than what has been perhaps added in the last 20 years. But the problem with that is that the new financial influencer sort of model, the self-professed gyanis that we've seen, investors have started to think that investing directly, they can perhaps, and trading directly, they will be able to make more money in their than their respective jobs or businesses. Now, doing a business, in the commerce words, starting up a business is not easy, but perhaps everybody can get into investment. And in their own assessment of their portfolio, less than 1% of active traders are making 7% or more. Now, and that's a bank FD. Now, the fact is, why are these so many guys going into active trading? The fact is that they are seeing it on social media. So and so stock made so much money, the next multi-bagger. The fact is that the top three companies of one business house constitutes more than 80% of total market returns. How many people are able to actually read, analyze, and figure out that the same business house is extremely underinvested by active mutual fund managers who have 20 years plus track records? There is a reason why that happens. There is an asset allocation, a strict risk control in portfolios that happens. Um, so one of the social media myths that I would want to say is that investors need to understand active trading does not really add value unless you are specially trained for it. The first point that I think Kaustubh had mentioned about was the number of people who are investing for short term versus long term. The more longer term investments that you make, you will actually end up adding value to your portfolio rather than active trading. The second, perhaps a big one, which has been around for a while, and as we step into a year which is a decade for the direct plans, there has been, I think, there was some report published how have direct plans fared versus regular plans. In the wake of saving that extra basis points on marketing and selling expenses, investors tend to sort of maybe underestimate the power of advice. Power of advice is not about really which fund to buy, or which stock to buy. It is sometimes also about managing your own behavior. Why do you go through 12 years, 15 years of school, college? Because somebody else is trying to instill a sense of discipline in you. You get up in the morning, go to school at 8 a.m., you come back at 2 p.m., you spend X number of hours sitting in a school chair or something. Now, the reason for doing all that is there is a discipline that you require, and somebody else only can perhaps build it for you. And which is the difference that you need to understand between a direct and a regular. So unless you believe that you are able to, or you know your strengths, your behavior, it's perhaps better that you understand the difference between that direct and regular. An advised portfolio has generally done better than a direct portfolio. Why? Because of the simple behavior bias that we've seen. Somebody had mentioned about, I think Amit had mentioned that the last time round, the top selling fund was an IT fund or a technology fund or a digital fund. Perhaps this year it might be gold funds, just because investors are coming, DIY investors are coming and seeing last 1 year returns, last 3 year, 5 year returns. But the fact of the matter is, this is what advice does for you. So please be aware, please research well, please take advice if you need, and then invest. I think timing is not something that you can do, because if you were able to do that, you would have become an investor before you became a businessman or a service professional or something. Um, uh, Take advice. There are advisors, there are IFAs, there are banks, everybody who's doing it. They're trained professionally to do that for you. So these are the two myths, maybe in the interest of time, that I would probably want to limit myself.
All right.
Gautam,
Don't get swayed by.
Gautam, one thing which
Yes, Amit.
Abhishek said, I 100% agree. Abhishek, just to add to what you said, Twitter actually makes you think that you are wise. Instagram makes you think that you are a photographer. Facebook makes you think that you have very much a lot of friends, and direct investor thinks that he has saved a lot of expenses. Let me tell you only one thing: the wake up is always tough, Gautam. In all of these, whether it is Twitter, Instagram, Facebook, or direct investor, the wake up is always tough. So that's why you need
Hmm.
somebody to handle.
Absolutely. Don't get swayed by hashtags. Do your own due diligence. And to
Absolutely.
take a storybook analogy, if you look at the social media universe, and you ask the question, mirror mirror on the wall, who's the smartest of them all? The ones who do the due diligence, the ones who do the research, and who take the right kind of advice, they are best placed. They are the smartest of the lot. Who don't get swayed by the herd mentality or run in the bandwagon of these new and upcoming investment opportunities. Well, we've had lots to discuss in this panel on emerging trends in the mutual fund space. Joydeep, I have about 15 to 20 seconds left for you to sum up things.
Amitabh said, कोशिश कामयाब होती है. In investing,
Hmm.
करिया कामयाब होती है. That's all.
All right. On that note, we'll wrap up our panel on emerging trends shaping the mutual fund space. And indeed, with paradigms of fund management evolving rapidly and product offerings by industry players becoming diverse, staying up to date can help you make more informed investment decisions. And to that effect, I'd like to thank the panel for providing as much information and insights as they could to our viewing audience to make the right decision. Thank you so much for being part of this panel. All right, let's move on to the next item in the agenda. We've also been speaking on inflation, and remember, inflation impacts every aspect of our finances. And to have a fruitful investment journey, now it is important to have a clear understanding of how our financial situations they change with ebbs and flows of the inflationary curve. So for our viewing audience, here's a short video to help you get a clear picture of the impact of inflation.
Inflation is the rise in prices for goods and services over time. It affects you by reducing the purchasing power of your money over time. This means as time passes, you pay more for the same essentials such as food, clothing, housing, transport, etc. Over time, inflation also reduces the value of your savings that are not invested right. Here is the impact of inflation over the last 25 years, explained using the cost of groceries. Imagine a typical family of 4, 2 parents and 2 children in the year 1997. Assume they spend 1,000 rupees on their groceries every month. Here is how that cost would change due to inflation. Notice how the cost rises year by year. From 1,000 rupees in the year 1997, it has become nearly 5,000 rupees in the year 2022, which is a 5 times increase in prices. In 2022, you pay nearly 5 times more money compared to 1997 for the same goods and services. As a result, the value of your saving of 1,000 rupees in 1997 would be roughly 1/5 or 200 rupees in the year 2022. Let's see how this will change in the next 25 years by taking the same example. For a typical family of 4, the cost of groceries in 1997 was 1,000 rupees. In 2022, it is nearly 5,000 rupees. Assuming a 6% rate of inflation, let's see how this cost would change over the next 25 years. Notice how the cost rises year by year. From nearly 5,000 rupees in the year 2022 to nearly 20,000 in the year 2047, which is a 4 times increase in prices. In 2047, you could pay 4 times more money compared to 2022 for the same goods and services. As a result, the value of your saving of 5,000 rupees in 2022 would be roughly 1/4 or 1,250 in the year 2047. As the cost of living goes up, your savings might not be able to fulfill your dreams of buying a car or a house. They might not be enough for a comfortable life. But don't panic yet. There's a way to protect your savings against inflation. You can lessen the impact of inflation by investing your savings right. Invest regularly, invest wisely in this Nivesh ka Amrit Kaal.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Indeed, invest wisely and always keep your eye out on the inflationary trends which are playing.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.